Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Happy to be back with you again today. I'm your host, Dr. Alan. I know you'll enjoy today's show, and I have a big ask that will only take a moment of your time. Ratings and reviews are the lifeblood of our podcast. To leave a review and a rating, iPhone or other Apple iOS device users, go to Apple Podcasts or iTunes. For all you non-Apple device users, go to podchasers.com. On either site, search for Real Estate Investing Abundance. Once you find us, leave both a review and a rating. Subscriptions are also vital to the show's success, so please be sure to subscribe on your favorite podcast app. It's free to subscribe, and you can unsubscribe at any time. Enlightened investors. 1031 exchanges are a powerful way to use the tax code to help defer taxes. Our guest, Brandon Bruckman, helps real estate investors, farmers, and business owners defer tax and invest in passive assets. He is an advisor with Insight Real Estate Partners. Prior to Insight Real Estate Partners, Brandon worked at a prominent hedge fund as the lead of fixed income financing. Today, we explore with Brandon the tax advantages of 1031 exchanges. Brandon, before we get into real estate investing, share with us an experience from your formative years that helped you to be the person you are today.
Thanks, Dr. Allen, for having me on. Awesome show that you're running here. Really appreciate it. My goodness, an experience from formative years. There's so many. I think my mother always had really smart words and advice for me that was very poignant, right, into what I was doing as a young person. And it was she was very clear about it. So she'd say things like, if you don't have anything nice to say, don't say anything at all, which is always a kind of cliche piece of advice, but a very good one. Overdress, don't underdress. Really simple things for things. Should be embarrassed that I'm not wearing a suit and tie right now. Now I'm thinking I'm showing my mom some of these principles, but such a good way to my mother's very influential in being very disciplined and being able to stick to this sort of code, your morals and built-in morals and your set of code in the way that you approach the world. That really came from my mother and the way that she approached the world.
Interesting. There was a study that was done by Harvard. It was a longitudinal study that started back in the 1930s. They carried out this study of this same 300 or so men from their college years up until they passed away. They recently published their findings, and the one thing they found that all successful men had, and the most successful of successful men, were they had positive and supportive relationships with their mothers. Fathers didn't make that much difference in how successful men were, but fathers played a big part in them learning to play and how to be playful in life. So
I was going to say, I hope I still have a role. Don't show that side to my wife. I'm going to get kicked out here.
No, you do have an important role to play. Brandon, take us into the 1031 exchange process. Many of our viewer and listeners don't know what that is. So start from the basics and tell us what a 1031 exchange is, and then you can get into how that is beneficial to us as passive investors.
And that might be true for some of your guests too. This is a nuanced sort of law that we have to help us. And there are various rules for us to follow, and we have to be exact about that. So I'll go very high level and not delve into the weeds, or let you take me there if you like. From a very highest level, 1031 exchange. 1031 is a section of the IRS tax code that allows us as real estate investors to defer tax, state, federal, and also depreciation and recapture. It's a little bit of the details, but it allows us to defer those tax bills and roll into another investment property. So very simply, that's what it allows us to do. So one amazing tool, is a side note that I didn't know about in my younger career as an investor. I was very financially market focused. I worked at a hedge fund for a long time, and I shunned real estate. I'm like, that's illiquid. I don't want to touch that. Not interested. Lo and behold, no one told me about 1031 exchange, and I could defer tax. So like your after tax gains here, you start to look a lot different than when you're investing in equities in the market. I'm like, oh, okay, now this is interesting. Yeah, let's talk about this a little bit more. So huge tool to help us do that, but you have to follow very specific rules. Number one, and we get these calls all the time, every week. Hey, I'm holding a check. I just sold my property. I'd like to do a 1031 exchange. You can't do that. So you have to have what's called a qualified intermediary stand between you and that check and hold it for you until you're ready to make that next purchase. So that's number one. It's critical. You have to have that in place before you head to the closing. I have to see that on a closing statement, not your name, the name of that qualified intermediary on behalf of you taking possession of those funds. So that's first point. Start there. Part two of this is we have very tight timelines to think about. So there's two timelines that folks need to think about. One is the 45-day mark. So you have 45 days from closing to identify properties that you might want to invest in. So I'll get to those rules about what that means in a second. 45 days is not a long time. So we need to keep this in mind before we get to, and we get these calls all the time too. I'm on day 40, help. We can help you on day 40. We prefer to help you 3 months before that to start to think about strategically how you want to approach this. So 45 days is a key mark. The next mark is 180 days from closing. We have to close on that next property. That's more doable and feasible. The 45 days is the one where people have a lot of problems. So at that 45-day mark, like I said, we're identifying properties that we may want to purchase. Okay, so there's 3 rules to go about that. And here we'll get into the weeds a little bit. So the first rule we see all the time that folks use is called a 3-property rule. Very simply, that says you can identify 3 properties. You have to close on one of those properties, okay, or a combination of those 3. Most people use that rule. It's the most flexible rule that's offered, and it gives you at least some level of optionality between that 45 and 180 days. So that's rule 1. Rule 2 is called the 200% rule. And that says you can acquire any number of properties you like, as long as that doesn't exceed 200% of the fair market value of what you sold. Okay. So that rule gives us a little bit more flexibility, especially when we're looking at passive assets that may have a portfolio of assets in that passive asset. And all of a sudden we're investing in 20 properties and we sold 1. We can do that in 1031 exchange. We just have to utilize that rule. That rule doesn't give us a lot of optionality between 45 and 180 days. There's not a lot we can do to change that. Huge gray area of 1031 exchange. If you had 3 people on here that are experts in our field, they might give you different answers about that. I want people to be very conservative when they approach this. Whenever you do a 1031 exchange, you are an audit risk. Okay. And so you're having your CPA stand alongside you in this and being very conservative about how you approach it is really critical. So there's no monkeying around to do on the 200% rule. We've got to be very clear about what we're trying to do. So that's rule 2. Rule 3 is rarely used. It's called the 95% rule. And it says I can acquire any number of properties I like, but I must close on 95% of that value that I've identified. So that rule really locks us in absolutely into what we need to buy. So what we identify again is probably part 3 of this. That's very critical. And the overarching thing I'll say about 1031 exchange, and I'll probably repeat this 10 times during our talk, you need a plan up front. And the people that you really need on board, number 1 is your CPA. They are the tip of the spear that's driving this and will help you understand what rules make sense and which ones don't. If you don't have a good CPA that has a real estate specialty here, get one. They're easy to find, or have them work with your current CPA so that they can work on this. Some CPAs don't do this every day. We run across that all the time. And I become more familiar with the rules than they are. That's not a good place. We don't want to be there. The CPA has to be leading this charge. So having them in place, qualified intermediary, critical to have these 2 people on the team. If you're considering something passive, talking to someone like me as well, and thinking about these things before you're even in that selling phase. Those are the people that do the best. Our clients that do the best in this spot have started to think about this before. They're like, I'm thinking about selling these properties. That's the call that I want to get. That's perfect. So we can lay all this out in an organized manner. And then when we approach those exchange deadlines, they're not a big deal because we're ready to go. I probably over-answered your question.
No, but there's a lot to break down. Are you a qualified intermediary?
Great question. No, I'm not. Okay. So I do not play that role. So our role in this equation is if you're looking at 1031 exchange, you own assets and you're like, man, I don't really want to manage these anymore, or I want more passivity in my investments. That's where we come into play. Okay. What we'll do is we'll spend our time doing due diligence on the various items that are offered to investors as 1031 exchange eligible to help you build a portfolio and pick out ones that work for you and make sense. That's our role in this equation.
There's one thing I didn't hear you mention, which I think is a part of 1031, and that is a like-kind exchange. Before we start breaking down all of these other elements, talk to us about the like-kind exchange.
Yeah, I did miss that part. Thank you. It's very misconstrued often. So I'll see questions like, hey, I have a single family. Can I 1031 exchange that into a multifamily? Yes. I have a farm. Can I 1031 exchange that into self-storage? Yes. Its investment property, very broadly construed, is like kind. Things that aren't like kind are REITs, are stocks, are partnerships. And that'll be very critical when we get into some of these details and talking about how to access syndication. through 1031 exchange, you can't do it in a normal syndication GPLP type structure where you're buying a partnership. You're not actually buying the real estate, which is very confusing for people to say, wait a second, I'm investing in a real estate deal. That's real estate. It's not really. Look at your docs. You're actually investing in a partnership. That's investing in real estate. That doesn't work for 1031 exchange. But when we're talking about, again, the questions we get all the time are like from one asset type to another asset type, all in 1031 exchange world.
We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
That's broader than what I had understood it to be because I didn't realize you could exchange a farm for a multifamily home. Since they're both real estate, they're considered in that same class in terms of the 1031 exchange. Is that correct?
Absolutely. And it's probably at two parts. One of the issues that I think from an education standpoint and understanding, I think most farmers approach this that we've talked to and say, if I use 1031 exchange, I'm just going to trade up and buy more farmland. That's their game plan with 1031 exchange. And so it's not even a thought process for them to think, oh, hey, wait a second. My family doesn't want to run this when I die. I'm slightly tired from doing this work. And frankly, the economics aren't working out for me as well as I'd expect. I can do something else. They don't even know that. So there's a huge education gap there, but it's absolutely all of that is.
Yeah. Okay. That's good to know. I can understand why it is that you play an important role as an advisor, because from my experience, most intermediaries will facilitate the process, but they generally don't have a lot of resources to advise in that process. So you essentially have to come to them with a fair amount of knowledge and understanding of that 1031 process. And then if you've got that knowledge, fine and good, then they'll facilitate it. But they certainly are not giving the information that you're providing here today. So backing up to the 45-day deadline, that is 45 days from the close of whatever asset you have to identifying the properties. Talk to us about that identification process. Does that identification process mean I have a contract on this new asset?
Yeah, it does not. The identification process is frankly very easy, but we have to be very specific about it. So we can't say things like apartment building I'm saying in Milwaukee, Wisconsin. I can't say apartment building in the south side of Milwaukee. Like, that doesn't work. We need an actual address on the form of what you plan to identify. So we have to be very specific, but by no means do we have to have a contract on that particular piece of property. So I think where most people have a problem with the 45-day and 180-day is they don't have a plan. So they walk into this and they sell their property, which takes a lot of effort to do. Even in this market, it is time consuming to perform that activity, but they're so focused on that. Okay, I'm done with that. Now I'll go worry about what to buy next. And they're like, I'll just throw those 3 properties on the form. And invariably what happens, all 3 of those have some sort of problem and they fall apart. And all of a sudden you're paying your tax. So it's that planning sort of process. And I think people are misconstrued and they think that there's a lot of optionality at that 45-day mark. Not really. No, there's not. It really isn't. We got to have a better plan than that. Like I said before, like our best clients walk to that 45, they walk to closing and we're allocating to the next investment a day later. Like that, to me, that's beautiful music. Like we plan really well. And there's no reason if we know what to invest in, we shouldn't go right away. We'll start earning income. It's not sitting with a QI. So yeah, you got to be on it way before we're thinking about selling this to execute.
We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. Yeah, 45 days is a small window, and in multifamily, it would be almost impossible without prior planning to be able to identify within 45 days. So you can identify 3 properties. By 45 days, is there a max, or you can identify more than 3?
You'd have to shift from the 3 property rule to that 200% rule. Once you're into that utilizing that 200% rule, you can put any number of properties on there that you like. Okay. But you're going to have to probably close on the vast majority of that. There is a bit of a gray area on what you ultimately allocate in the code, but it isn't clear. If you read through the actual, we don't want your listeners to do this unless they want to fall asleep, to read through the actual 1031 exchange code. There is no guidance in there that says you have to, using the 200% rule, you have to acquire this amount of properties. There's no guidance to that. There's an example given, but it is very broadly utilized by folks where there's some variability in the way they interpret that. We always advise people, hey, let's be very conservative here. If you've identified these properties at using the 200% rule, we better be darn sure that we're going to close on them. And we better execute that.
You also mentioned the 95% rule. That means the value of the next properties cannot be less than 95% of the selling price of the property you just got rid of. Is that right?
No, that rule is really locking you into exactly what you've identified that you have to purchase. So when we talk about, it is an important aspect though that, and I'll spin your question a little bit. It's an important thing to think about. We ask this question a lot of what do I need to invest to defer the tax? And so some people come to the situation, they're like, my gain is 100,000. So I got to go invest 100,000. Not true. You have to invest all the proceeds from the sale of your property in order to defer the tax. So in those situations where you have debt, it gets a little more complicated. You do have to recreate that debt and equity situation in your next property or trade up. If you trade down, you're going to have this thing called boot, and that excess boot is going to be taxable. So anything you can do that too. You can do a partial as a partial exchange. You can do that. Say, hey, I really like this property over here for $200K. I sold this one for $500K and I like the cash. Okay, you can do that. You're going to owe tax on the difference. But you can do that. It's executable. But you can't walk into this and say, I have a $100K gain, I got to invest $100K. You got to bring the whole proceeds to the equation.
This is clarifying a lot that I didn't totally understand about the 1031 exchange. I didn't know you could trade down, but you can. It's just you're going to pay taxes on the difference. I'm not real clear yet on the 95 and the 200%. So what's the difference we're talking about?
Yeah, it's interesting. So we probably have a different opinion of this. I don't see a big difference, frankly. And we don't see that 95% rule get utilized ever. So for most of our clients, we're utilizing the 200% rule because in many cases, we're building portfolios that have more than 3 properties in them. So we're leaning on that. The vast majority of people we watch go through use that rule or the 3 property. We rarely see 95. But to us, if you don't have the optionality, which we believe you don't really have the optionality in the 200% rule, how is it any different than the 95% rule? It's in essence the same. So we don't see any difference there. The only caveat they'll give to that is if you do want to acquire more than 200% of the fair market value, what you're coming into, that's when I think you start utilizing the 95% rule. But in function, it operates the same way.
Okay. But your exchange doesn't necessarily have to be 200% more than what you just sold, but it can't exceed that unless you go to the 95% rule. That doesn't mean you can't purchase properties that are more expensive than that, but you're only going to be able to use the deferment on the 200%. Is that correct?
Think about it this way. So think about you're coming into the equation with a certain amount of proceeds and potentially debt. And then you have the tax associated with your gains that you're coming into the 1031 exchange with. If you're reinvesting all of that, it doesn't matter which rule that you're utilizing. It's inconsequential. You're going to make that deferral if you're investing all those proceeds and bringing along the debt with you. If you do that, you can utilize any of those rules and defer all of your tax.
Enlightened investors will be right back after this important announcement. I have a big ask that will only take a moment of your time. Ratings and reviews are the lifeblood of our podcast. So to leave a review, iPhone or other Apple iOS device users, go to Apple Podcasts or iTunes. For all you non-Apple device users, go to podchasers.com. On either platform, search for Real Estate Investing Abundance. Once found, please leave a review and a rating. Subscriptions are also vital to our show's success, so please be sure to subscribe on your favorite podcast app. It is free to subscribe, and you can unsubscribe at any time. That clears up a whole lot. So you're saying that most of your clients are coming into this and they are purchasing multiple properties rather than just a single property to replace the single property that they are selling. Why is that?
Yeah, I think there's a couple of reasons for that. I think a lot of our investors are seeking diversity. Let me step back. We have two different types of investors that I would say are real estate investors. One type is someone who's been managing real estate for 20, 30 years. They might have a handful of larger multifamily and they don't want to manage the stuff anymore. They're done for various reasons. It could be age or health, or frankly, they just don't want to deal with this sort of environment that we're in, right? Of moratoriums on evictions and COVID. It's man, it was hard enough before. Now it's even harder. So they're looking at this as sort of retirement. And then they're turning around and saying, okay, we need to build a portfolio of properties that produce cash flow because I need this level of cash flow to continue to maintain my lifestyle and what I want to do. And I think we can accomplish that in a portfolio to sort of de-risk ourselves or diversify. And you use that term broadly. Think about that. But I think that's the thought process that set of investors coming into is how do I diversify myself across different asset types and across different geographies to produce cash flow and push down risk. So that's one side. That's why they're approaching it. The other side of that is someone who's probably closer to maybe my age and is a full-time professional and they have some real estate on the side and they're hitting property number 3, number 4, but they're looking at the amount of work and time it takes to maintain that versus the time they're giving to their full-time job. And it's like, oh, by the way, I just had 2 new kids. So, okay, stop. Like, you don't have time for this. And so they're coming to that realization they don't have time. And then so they're then turning and looking at this the same way that the retiring real estate investor is, and how do I diversify? And how does this fit into my overall investment picture? And that's something we'll walk folks through as well. It's like, how do we do that? So they start looking at it the same way. They have different goals. I think absolute returns become more important for them than necessarily year one cash flow. Start asking different questions about those investments, and we're tailoring our portfolio differently. But we're getting to the same place of, I can't manage this stuff anymore. And it becomes these choices become lifestyle choices. They have economic tinges to them. We always start there. They always end up being a lifestyle decision about what you want to do and how it fits. And so that's kind of why we're walking down this multiple property path. But I would say like the vast majority of 1031 exchanges that occur, they don't necessarily hit our desk, but they're very straight 1-for-1 type properties. I think if you look at the industry holistically, the vast majority of exchanges look more like that. This is more of the exception.
You had mentioned this aspect of if you're going into syndication, most often you're actually investing in an LLC, which is a security, not a property. But if I understand this correctly, you could 1031 out of one syndication into another syndication because you're exchanging one security for another security. Is that correct?
No.
So
you're still holding a partnership. You're not holding an actual real estate asset. That we can't do. So you can't 1031 exchange from a financial security to a financial security. That you can't do.
Okay. So it has to be a real estate.
It has to be a real estate investment or real estate used inside of a business like a farm or a office building that's used inside of your business for business function. Okay. Those are the only assets now that are 1031 exchange eligible. And so if you're looking at, let's talk about maybe syndication for a second. Like, how can we go after this? So there's 2 parts of this equation that become passive options for our investors. One part is to think about syndication, but to change the structure. So you can change the structure into what's referred to as tenant in common, which you become a partial owner of that property with other folks that are in that same situation. So that's a way to do it. And we've approached syndicators that typically do the partnership structure and said, hey, there's a lot of 1031 money coming. Would you like to have access to some of that capital? And some say yes. Others say, no, that's too complicated for us. And we don't want to go through the hoops that it takes to institute that structure. We like the partnership structure. Our investors like the partnership structure, and we're happy with that. And that's fine. I understand. TIC's harder. You're giving in just aspects of the TIC are very different from the partnership. In many cases, you're giving investors voting rights. That's very different than thinking about a partnership structure, right? In some cases, the investors have to be recourse to the debt as well. That is vastly different. So when we think about approaching investors and syndicators to do this, we are thinking about the capital size they're coming with. We're thinking about fit, how you fit together. And I feel like a matchmaker when we play this game a little bit. So your personalities fit together, because ultimately you're going to have to make pretty big decisions together, and you got to be really comfortable with that. But it is a way to gain access in that. And we're watching syndicators look at this from their seat and say, hey, if I do want to trade up into buying $20, $30 million properties, I may need access to some of this capital, and this might make a lot of sense. So that's one way from a syndication perspective that folks with 1031 money can get involved.
Brandon, tell our viewers and listeners how it is they can get in touch with you and take advantage of the offerings that you have.
Yeah, easiest way to find me is to shoot me a message. It's Brandon at insight1031.com. Insight 1031 is the website. You can go check out there. I'm also very active on LinkedIn. Just search my name, you'll find me. Tons of content there for investors to get comfortable with the syndication things we're doing. And the other aspect or tool we're using is Delaware Statutory Trust. And that's probably another half an hour for us to have a conversation about that. But if investors head to our website, they'll be able to find a ton of information about that as well.
Is there any last thing you'd like to share with us about 1031 exchanges that we haven't been able to cover?
I just want to continue to pound the point home that folks got to plan for this. You got to be planning for this. Again, if it's going through your mind that you're thinking about doing this or selling your property, just start planning it all the way through from start to finish. That's the play.
Brandon, let's go into our last segment. And if you would, please share with us one of your most difficult setbacks. How did you come through that time, and what did you learn from it?
I thought about these questions before we started. You're kind enough to provide them before, which is helpful. I was trying to narrow it down. I think one of the things I mentioned earlier is I spent a considerable amount of time at a hedge fund. It was a rather large hedge fund. And I walked through the financial crisis there. And a lot of what I was doing was around subprime mortgages. So if you've ever seen the movie or read the book, The Big Short, I lived The Big Short. So when my wife's watching this movie, she's like, this is not entertaining. I lived this life. It's very stressful. Those are the stories of the winners. And certainly we weren't winners in that equation. So at that time, as a young person, it was an incredible thing to watch something you admired so much in that firm kind of break down. I would still be there today if that firm existed in its entirety. So that was a hard thing to deal with, to watch people that are smart make bad decisions or decisions that didn't work out. That was interesting. So that had a big impact on me in the way that I think about investing and approaching markets and the way I think about due diligence. And I think that still holds up sort of today. And it was more of, it led me to think about doing more homework and avoiding sort of narrative that was attached to some of these things and making sure I understand how does whatever it is that we're talking about from an investment perspective or business perspective, how does that work? And then what are the levers we can use to pull to make that work? And I think that carries through in our due diligence process now. I think folks would be surprised at how few questions we asked, but how poignant they are. And if we can't get answers to them, that's it. Like, you're done. So I think I learned, although it was very painful to go through that process of being there, I think there's a lot of benefit that comes from living in the fire, so to speak.
Well, 2008 was living in the fire and was a very painful time, as well as very educational for many of us. Hard lessons learned.
Yeah.
What in your life are you most grateful for?
That's funny. And I was thinking about, first thing that popped in my head was like everything. When you take the time to sort of think about things like, in broad strokes, like the time in which we live in, like where we live, and the fact that I have people that I can support and I have people that love me at the same time. It's almost overwhelming to think about the things that we're grateful for. So all of the above, tremendous amount of gratitude for that. And just being healthy. You think about people that, and we had COVID run through our family. You think about people that are just struggling with that right now. And I can imagine people that have some sort of pre-existing condition and had to deal with that. That's unbelievable. So we're all those things. I have a tremendous amount of gratitude for that. It's really important though. I'm glad you asked these questions, because I think it's incredibly important for people to think about that every day, especially when they get maybe irritated or upset or mad about something, is to think about broadly the time in which we live in. It is quite incredible.
Yeah, there is a guided meditation that I listen to every now and then. One of the things he points out in this meditation is what an incredible time that we live in. Just thinking of how we can, at the touch of a button, reach out and touch people all over the globe. We could not do that 20 years ago. It's just a phenomenal time that we live in.
There's two stats that I usually drop on people that I don't think they have a great understanding of. It's one, we've never lived longer in the history of the human race than right now. It's incredible to think about. Never, ever in the history of humanity ever lived longer. And two, there's never been a lower level of extreme poverty than there has been right now in this time in history. That's an incredible thing to think about. If you had to judge our world on just two metrics alone, I'd choose those two. And I think we're doing pretty well. So I just keep those in mind next time we're having a bad day, is to think about those two things are amazing.
Yes, and bad days come to all of us. It's easy to focus upon the negative and forget the good. So that leads us into our next question. What 3 good things have happened to you in the last 24 hours?
What an interesting time for you to ask that question. Yesterday is actually my birthday. Oh. And so what an interesting time to reflect on all the things to be grateful for. So in the last 24 hours, my wife prepared an amazing meal for me. Came home early to do that. I went and hit golf balls with a great friend of mine. And that was a ton of fun. And I did a call with an amazing syndicator group in Ohio that's doing affordable housing. And I connected them with a group of lawyers to help them do some of the tenant in common structure that we talked about. So to enable that and that's the last 24 hours. And so I was sitting here before we got on the call. I'm like, man, that's a pretty good 24 hours. So those are the list.
How are you putting your success as an investor and entrepreneur to work to create universal well-being and abundance for all beings?
Yeah. And this is something like I've had to get more involved in the last probably 5 years or so. I encourage people to read a book called Evicted. It's about a housing situation, and it's based here in Milwaukee, Wisconsin. And it is as accurate as it gets. And so I have the honor to sit on 2 boards in particular. One is a daytime homeless shelter here in Milwaukee called Repairs of the Breach. And the other is the Apartment Association of Southeast Wisconsin. So I'm right in the middle of kind of the sustainability for housing in our area. And I feel a responsibility to do something about that. So there's a lot of great things that, frankly, the Apartment Association is leading on to take us down a mediation route instead of an eviction route. So that's a huge thing to think about, is to sort of unwind decades of legacy in this city of mistrust and of, frankly, inefficiency in the way our housing works and our sustainability. So that's where I've been spending a lot more time on that front. And then to help folks from the repairs perspective, how do we help them get into a sustainable situation? So we're doing some great work there as well.
Does sound like some phenomenal work. And thank you for doing that. When you leave this world, what do you want as your epitaph?
It's funny. I was thinking about, first I looked up epitaph, and then
I don't mean that literal, take that literally, but metaphorically, what do you want on your epitaph?
It's so funny because I was thinking about this and I'm like, and I think maybe this is true for a lot of us. I experience different people in different ways, and I think they view themselves. So I'd probably leave that blank and let people just experience, understand me from their perspective. And I don't really want to change that for them. So some people look at me in one way and others in a different way. And I mean something different for everyone they encounter. So I almost want a blank slate for them to experience that as they see fit, instead of me dictating that, if that makes sense. Frankly, it's not important enough for me to say, hey, this is who I was. It's more important for you to know who I was and for you to experience that your way.
That's an interesting way to look at that, a perspective I don't think anyone has shared with me before. But I like it. Yes, an interesting way to leave the world and to leave it in a way that helps your creativity to continue. Yeah, interesting there. Brandon, thank you so much for being on the show. It's been a pleasure, and it's been very enlightening for me. So thank you.
Yes, likewise. I really appreciate it. Thank you so much.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.